Hi, welcome to the market outlook of Alpha Capital for the month of June 2022. There has been a lot happening in the markets. In the month of May, equity market in India almost corrected by 10%. We saw some bounce back. Globally also, the markets have been very volatile. We are seeing inflation going up, US, RBI, everyone hiking the interest rates. Commodity prices, crude, they continue to go up. And I'm sure you must be really confused that what's happening, how long will the crisis go, and how is it going to impact your portfolio. Now, in this video, I'm going to tell you about key insights which will help you in understanding the market developments better, which will help you in making investment decisions better, and which will hopefully make you take better decisions to generate better profit from your portfolio and create a lot of wealth. Now, before I tell you about the outlook of Alpha Capital, disclaimer as always, whatever we are sharing is the views of Alpha Capital. It's recommended that you do your own due diligence before making any investments. Now, coming to the market outlook, today in this market outlook, I'm going to talk about 5 things. One, I'll take you through what has happened in the market, especially the equity market, because in the month of May, it was quite volatile. I'll also tell you about how market is expected according to us to move going forward. The second thing which we are going to cover is the market valuation. How does the equity valuation looks like as of now? Are we in the fair valued zone? Third, we are going to talk about the US Fed balance sheet, how it is expected to move and what will be the implication it will have on the markets. Fourth, we are going to talk about the interest rates in India. The interest rates have been going up. What is the impact it's going to have on the debt portfolio, and what is the strategy for that? And last, I'm going to talk about behavior management related to investments, which is the most important thing of all, what I'm going to talk about. So what I'm going to do is I'm going to share a presentation. There are a few slides which I have, prepared for this market outlook. I'll share them with you. Now, in the first, chart, this shows that how the global equity markets have done in the last 1 month. Now, if we talk about the Nifty, which is the blue line, at the beginning of the month, it started correcting. It tanked almost by 8.5%. We did see some recovery, but, the month ended with a loss of around 4%. The green line, which reflects the Hang Seng, was still, it gave a positive return. And it gave positive return because China opened up the economy. The Chinese government, had put a strict lockdown due to COVID, which was impacting the growth. And with the lockdown, getting removed, that helped the Chinese market. Even the US market, which is the S&P 500 and which is shown in the black, it was volatile, and it recovered most of the losses. And it was down around 1%. So May was definitely, quite volatile. The Nifty 500, the Indian market, saw the, significant losses. It saw a loss of around 4.5%. But when we look at the same chart, from the beginning of this calendar year, 2022, it shows that, the Nifty 500, which is reflected in the black points, it shows that Nifty has been the best performer, in this calendar year 2022. It's only down 6%. Hang Seng is down around 9.9%, and US market has been worst hit with a loss of around 13.8%. The tech stocks particularly have taken a significant correction, and Nasdaq and all are down more than 20%. So this is what has been happening. So this has also been leading to losses in the portfolio for this calendar year. Now the question mark is, when will this loss stop happening and when will the portfolio start doing well? Now, we feel that the equity market is going to look for 2 important developments, which we feel that is going to have a huge impact on the portfolio or the market movement. One is, when is the inflation in the US expected to peak out? And second, about the Ukraine crisis. Now, inflation peaking out is important because the whole crisis started in October 2021 when the inflation started going up, and US said that it's going to hike the interest rates to control the inflation. Now, if we talk about the US inflation, the CPI last month came at 8.3%. and we will have the latest inflation number coming on this Friday, that is the 10th of this month, and we have a Fed meeting on 15th and 16th of June. Now, as per the Fed statements which are coming, and as per the various economists, the inflation is US is expected to peak out this summer. In fact, it's very likely that the number which come for this month, it will be much lower. And I think if that happens, it will also mean that the worst may be behind us. Because if inflation starts coming down, then the US Fed will not be very aggressive in hiking the interest rates. And it will also gradually wind up the balance sheet. So I think that the markets will bottom out, when inflation picks out. And so it's a crisis of maybe 3-4 months. And even in India, the inflation, which is at 7.79%, is expected to peak out somewhere in September, October. So I think once the US inflation picks out, you will see the markets bottoming out. The FIs have been selling since the last 9 months, which is a record. It did not happen even in the 2008. So I think once the inflation numbers are good, market will bottom out. Now, the second question mark is, when will it reach the previous high? When I say previous high, let's say the Sensex was at 62,000 in October. When will it get back to the same level? I think a lot will depend on that for when the Ukraine crisis stops. Because if the Ukraine crisis goes for longer, then the commodity prices stays very high. The crude will be high, which is if we talk about the Brent crude, it is at $120. And if it continues to stay high, and it's not just about the Brent crude, about other commodities also. All the industrial commodities are high. Now, when the commodities are high, the prices of everything goes up, the demand comes down, the earnings fall. And I think till the time this Ukraine crisis doesn't settle, the demand will be low, the growth will be less. Now, it may happen in 3 months, 6 months, or maybe 1 year. So I think during this period, markets may be range bound. So yes, there is a visibility that market may bottom out in next 2-3 months. But when will it make the next peak? We have to watch the Ukraine crisis. So that is the outlook which we have on the equity market for now. Now, the second important chart which I'm going to show you is about the valuation of the Indian market. Now, this is a chart which shows the P ratio. P ratio is a valuation indicator. Higher the P ratio, it means markets is overvalued, and lower the P ratio, it means markets are undervalued. Now, it shows the P ratio of Nifty 500 since June of 2017. Now, in this, the blue line is the Nifty movement of the Nifty 500, and the pink line is the Nifty P ratio. Now, if you look at the chart from June 2017 till pre-COVID, both the markets and the P ratio were flat. It did not move so much. The markets did not go up because the earnings were hit. Earnings were hit because of demonetization, GST coming in, RERA, because of NPAs in the NBFC. So the earnings were really not coming, and the P ratio was almost trading at 30. If you look at this P line, the pink line, the P ratio before the COVID was at 28-30. Then we saw the earnings and the markets coming down. Then the P ratio at one point of time was even at 45. And this was, at the beginning of 2021. And since then, what has happened is that earnings which have come have been phenomenal. And the P ratio today is only at 21. Now, if we compare the current P ratio of 21 to the previous P ratio, during the period of pre-COVID, when it was 28-30, seems like market is not very expensive. And 1 year forward P, we think that is going to be around 18, because we feel that earnings this year is going to grow at around 15%. Earlier, we thought that earnings will grow at 25%, but now we have reduced our earning growth expectation, largely because, due to high inflation, high commodity prices, the margins of the companies will get hit. So looking at the current P, market seems to be fairly valued. It is at a large 5-year average. But if we compare it large 10-year average, which is around 18-19, then it looks slightly expensive. And if we also look at other emerging markets in US, the P of other emerging markets in US are much lower. So from a relative perspective, Indian market looks expensive, but on a standalone basis, we think markets are fairly valued. Now, when markets are fairly valued, it gives a lot of comfort. It also means that any correction which happens from here won't be very deep. And even if it's deep, the bounce back which will happens very fast, because the market starts offering attractive valuation. So from a valuation perspective, I think the the levels are very good. And if someone has a 4 to 5 years time horizon, I think one should expect a return of 14-15%. The money should double. So good levels to stay invested in equity. But yes, we may have short-term volatility. Now, the third chart is about the US Fed balance sheet. I talk a lot about US markets, US Fed, because US is the global growth engine. I always tell my clients about this, that the correlation between Indian markets and US is very high. What the US Fed does definitely has a lot of impact in the Indian markets. Now, talking about the US market developments, as I told you that the US Fed has been hiking the interest rates to control the inflation. The CPI in US came at 8.3% last month. Now, US started hiking interest rates in March of this year. It hiked from 0.25% to 0.5%. And again, in the month of May, it hiked from 0.5% to 1%. Now, the new inflation numbers in US is going to come on 10th, and they have the meeting on 15th and 16th of this month. Seems like the US is again going to hike the interest rates by 0.5%. And total, it is expected that the Fed is going to hike the interest rates seven times in this year. Now, the pace of the hikes will depend a lot on how the inflation number comes. The 10-year GSEC in US has already hit at 2.95%. So most of it is already discounted. But there's a new development which is happening in the US markets. Now, normally what happens, US controls liquidity in the system by two measures. One is, by hiking the interest rates. The second is, by buying bonds from the market. And that's which is also known as quantitative easing. When Fed goes in the market and buy the government bonds from the public, it, pumps in liquidity into the whole economy. And that's what government has been doing since 2008. And even at the time of 2020, the government had bought a lot of bonds. So I'll show you a chart related to that. Now, this is the US Fed balance sheet. This is since the year 2000. The red line shows how the balance sheet has moved till now. The US Fed balance sheet is around $9 trillion. Now, if you look at around the period due to COVID, the balance sheet, significantly went up because the US had bought the bonds. But the buying of the bonds have been continuing since 2008. Around 2008, the balance sheet was $1 trillion, and due to quantitative easing, it has been buying continuously. Now, to control the liquidity and to control the inflation, the Fed is going to sell the bonds in the market. And the bond selling started from June of this year, or in the current month. And the Fed is supposed to sell $47.5 billion of bonds this month. And from September, they're going to sell $95 billion of bonds. So what will happen is, when they sell the bonds, they withdraw the liquidity from the system. So the Fed balance sheet is expected to fall by around 20%, by the end of 2023. This is, if this plays out, then there's a lot of liquidity which will come out from the market. And that's the reason why the tech stocks have been correcting, especially the US tech stocks. Even the Indian IT stocks have been correcting. That's the reason why the cryptos have not been doing well. That's the reason why private equity, VC, the stocks in the unlisted space are seeing a lot of correction. And if the tightening continues, I think there may be further more stress. But if due to inflation, if US starts entering into recession, then Fed may decide to go slow on the liquidity withdrawing. So we need to watch on this. And I think the recovery in the tech stocks, or all this crypto and all, will depend on what happens to the balance sheet of US. So we are watching this development, and I think this will play an important role in the months to come. Now, in the fourth chart, which I'm going to talk about, is what's happening in the Indian interest rate, Indian fixed income market. Now, RBI hiked the interest rates, the repo rate, from 4% to 4.4%. And this month we have the RBI MPC, or the Monetary Policy Committee, meeting starting today, and it's going to go till 8th of this month. Seems like RBI is again going to hike the rates by 0.5% to control the inflation, because inflation has been high. In India, the inflation is 7.79%, and the food inflation is much higher. So RBI is under tremendous pressure to control the inflation. But RBI is also not being very aggressive after inflation, because it doesn't want to degrow the recovery of the Indian economy. In fact, the Indian economy has just come back to the pre-COVID level. So the GDP of the economy, which was 147 lakh crores, which was pre-COVID, we've just got back to the same level. And RBI want to ensure that the momentum continues, the growth continues. So it's doing a good balancing act, and hopefully RBI will be able to control the inflation and provide good growth to the economy. Now, if you look at this chart, this shows the yield curve, for the debt products, the fixed income, the government securities. The blue line is for 31st March 2022, and the red line is 31st May 2022. Now it shows what has been the change in the interest rates. The bar shows what has been the change. So if you look at the 1 year, the interest rates have gone up by 1.3% in 2 months. So currently the 1 year bonds are yielding around 4%, which was around 4.7% 2 months back. Similarly, 2-year yields have gone up. 3-year yield is at around 7%. 10-year bond is at around 7.4%. So if you look at the yield curve, it is almost getting flatter, and earlier it was steep. Now this is good for the investors in the debt funds, in the fixed deposit, in the fixed income products, because they will start seeing better returns. In fact, if you check the yields in your debt funds or even the FD, the rates have already gone up. Now, we feel that the rates will further go up because inflation seems to be sticky. It's not coming down. And RBI, as I said, that in India, the high inflation is expected to be there till September. So if it stays like that, RBI will continue to hike the rates, and maybe we'll see interest rates going up by another 1.5%. So, the one year rates may go to 7.5%, and the 10-year rate may even go to and cross 8%. Now we are, requesting our clients and recommending our clients and suggesting our clients that they should stay invested in the shorter end of the yield curve, because when interest rate goes up, the underlying bonds underperform. They see the price correction, and the impact in the price of the bond is lower or less on the shorter term papers than compared to the 10-year bonds or 5-year bonds. So don't invest in the longer term bonds, because we are still in the interest rates increase scenario. And yes, the debt funds have not given returns in the last 2 months, because as we see, the interest rates have gone up significantly. But as interest rate stabilizes, the accrual which will happen in the debt funds will be much higher. They will start yielding 7.5% hopefully. So whatever is happening for good. The fixed income or the debt funds were struggling after the COVID. They were giving yield of 4.5-5%. Now with this new changes, the interest rates will go up. So looks like a better situation, the story which will play out better in the coming months. Now this was, the 4 charts talks about the market developments on the fixed income, the equity. The last chart is very special. It's about behavior management related to investments. Now, if you ask me as an advisor, what do I do? Yes, of course, I track the markets. I look at what's going to happen and make investment plans. But one of the major role which I do, or the major task which I do, is manage the behavior of my clients. Because a lot of time clients panic looking at different market scenarios. When markets go down, they get hassled, they get worried. They feel that maybe market will further come down and they should sell. Or maybe when market goes up, they get the enthusiasm or the euphoria is very high and they want to put in more money. So as an advisor, I try to control this behavior. And if you talk about the new clients who have invested in the last 1-2 years, now they may not be seeing any return in the portfolio because market has been correcting in the last 9 months. And when they came to the market, they saw the past return, they saw the rally since March 2020, they felt that the rally will continue. And that's why there's an interesting chart through which I want to address this behavioral issue. Now, this is a research. Now, this is a research from the US markets, because the data is the history of US market is pretty long, and the markets are same everywhere. If a pattern holds in the US market, it also holds in the Indian market. Now, what it shows is you look at this table, and what it shows the probability of return of being positive or negative in different time frame. So, for example, if we talk about the daily returns. Now, daily return, there's a 53% probability that you may get positive return and 47% probability that you may see a negative return. Now, as soon as you increase your tenure by 1 month, the probability of making positive return is 63% and negative falls to 37%. On a yearly basis, the probability of positive return goes to 74%. And if we increase the tenure, in 5 years, it goes to 87%, in 10 years, it goes to 94%, and in 20 years, there's hardly any probability or zero probability of making negative return. So what is happening now is a lot of investors are looking at monthly return or daily return or quarterly return, and when they see negative return, they feel that markets are like this, and they try to exit the market. But let me tell you, markets are not like that. That's a probability which is playing out in the short term. But if you look at the longer term, the equity market does well. Especially when you're investing in equity, you should have a time horizon of 5 to 10 years. And in that time horizon, as we look at, the probability of seeing positive return is very high. So what is important is that you don't watch your portfolio on a daily basis. Try to watch on a quarterly or yearly basis. And that's how you will be able to reduce your panic. And so, as the heading says, zoom out. Don't go too much into investments, because managing your portfolio, watching the returns on a daily basis doesn't help in increasing the return. It only increases the anxiety. And so zoom out as much as possible. Look at your portfolio on maybe monthly or quarterly, and better if you watch on a half-yearly or yearly basis. But one thing is for sure, if your time horizon is long, equity is going to deliver the return you need to have. That's from our side on this market outlook. Thank you so much for your time. Wishing you all the great month of June, and hope that you make a lot of money this month. Take care and stay safe. Bye.